Hi, it's Chris here from Hunter Wealth, and welcome to another one of our Meet the Fund Manager investment series. Today, we're kindly hosted by Betashares. Betashares was founded back in 2009 and manage over 80 billion in funds across an array of different exchange-traded funds across a whole lot of different asset classes. They have over 1 million investors, and these funds are readily available on the Australian Stock Exchange and readily available on your major platforms. Today, I'm kindly joined by their Chief Economist, David Bassanese. Thanks for having us, Dave.
Good to see you, Chris. Good to see you again.
I have interviewed David on a number of occasions. He's regularly interviewed through the Financial Review and other major mediums. David, obviously markets have been trading pretty well on their highs, certainly on the backdrop of geopolitics, high inflation, higher interest rates, obviously a huge AI CapEx tech boom. So I guess my first question to you really is, where markets are valued today, should investors be nervous about where they are, or are they actually priced to perfection?
Look, it's interesting you mentioned that. So if you look at equity valuations for the global market, they're actually now trading at around about 17.5 times earnings. Now, late last year, they got up to almost 20. So far this year, actually, valuations have come down, although equity markets have gone up. And the difference is that earnings have been pretty strong. So we've had very strong earnings now for the last few years, underpinned by the tech boom, of course, in the United States, the big tech companies in the US generating very strong earnings. So this year we've had markets go up, but earnings going up by even more, which has allowed valuations to come back down again. So look, they're not cheap, but they're certainly not at the highest levels they were late last year. The long run average for global equities is around about 15, 16, so we're a little bit above that average. But against the backdrop of still fairly good corporate earnings outlook, if you look at earnings expectations, I think markets are sort of reasonably well priced. I mean, as you do point out, there's a lot of risks out there which we can unpick, but at the moment markets are, as they do, climbing a wall of worry, but underpinned by what is still has been, and at the moment still expected to be, a pretty good earnings outlook.
Okay. I did mention just in the intro, just inflation's high. It's obviously outside the Reserve Bank of Australia's range. So where do you forecast inflation over the next 12 months and the impact obviously on interest rates?
Yeah, so look, I should have mentioned, so Australian inflation, as is the case in many countries, the United States, also in the US, inflation is running closer to 3% on an underlying measure. Their target is 2%, so it's above their target. Our inflation rate, we got a update just the last week for the underlying measure of trim mean inflation, running at 3.6%. Obviously above the RBA's 2 to 3% target. RBA has raised rates this year. The Fed haven't. But again, at the moment, some of that you could attribute to the oil price effects. But in the case of the US, some lingering tariff effects. Donald Trump put up the price of imports last year through tariffs. So at the moment, I guess the way I look at it, interest rates in both the US and Australia, if you focus on just those two countries at the moment, the two most important for us, are at restrictive levels. And at least in the case of Australia, probably enough to help bring down inflation, slow growth. So I don't see the RBA raising rates more. In fact, the markets have now, certainly following the June quarter CPI number, which was a bit better than expected, at this stage don't expect further rate rises. In the US, the markets do expect 1, possibly 2 more rate rises this year. I'm still dubious about whether the Fed will actually pull the trigger and raise rates, because just in the last month, inflation's been on the lowish side. So my base case at the moment is I think interest rates are going to sort of stay where they are at restrictive levels in both the US and Australia, which will put a lid on growth and inflation, but not really upset the equity market too much.
So probably good for mortgage holders, and probably not too bad where term deposit rates are for deposit takers.
Yeah, I mean, if you're earning interest off deposits and whatnot, it's I guess a relatively high level at the moment. Not great for mortgage holders where rates are, but if there's any silver lining at the moment, it is that the rate rises we've seen to date do seem to be slowing the economy. Also, the budget changes, which we've all talked about in the past, that are seeing investors leave the market. So property prices in Australia are declining, and there's probably more of that to come. So that's doing some of the Reserve Bank's work as well. So silver lining is, knock on wood, that I don't think the RBA will need to raise rates again this year.
If I could just touch on currency, the Australian dollar has been bouncing around probably as recent last few days with Japan. Where do you see the Australian dollar over the next 12 months?
Yeah, it's a tricky call on the interest rate, on the currency, because at the moment, look, the key driver of that is relative interest rates. And at the moment, look, a few months ago, the expectation was the RBA was going to be raising rates aggressively, the Fed not, so the Aussie dollar was going up. We've had the tables have turned now. The markets have priced out more RBA rate rises, priced in some US rate hikes. And so the Aussie dollar's come back. I think it got up to around 72 cents US, and now it's just under 70. Look, I think it's a pretty mixed picture, so I don't see it going up a lot. I don't see it going down a lot. I think it's going to be range bound in that sort of around the 70 to low 70 cent range.
I mentioned earlier, just with the capex out of artificial intelligence, do you see, that translating into genuine productivity gains and revenue growth, sort of more broadly out of obviously the Mag 7 that are spending the dough,
yes,
into all these other companies?
Yeah, again, the jury is, look, the first few years of the AI boom, we were just loving the investment, and we were very, very excited about the potential payoff of that. Markets are now starting to question when and if that payoff will come. We did get some good results from Microsoft just the other day, and they're, for a large company, the share price reaction was pretty strong, showing that, people are taking up the AI services, their Copilot sort of addition to their traditional Windows products of Excel and Word and whatnot. There is take up there. Their cloud computing services are doing very strongly, part of which is AI. So I guess that's breathed some new life into the AI story. Look, to be honest, I think the jury is still out on whether or not the billions of dollars that they're investing in cloud infrastructure in the AI services, we will get a payoff. We need basically corporations, you and I, governments, consumers to embrace AI and be willing to pay for those services. But it definitely, the productivity potential is there. I think in the short run, funnily enough, it's actually adding to inflation in the short run. We're seeing the prices of computers and inputs into computers go up because of the demand for computer chips to power the AI data centers. So at least in the short run, it's actually adding to growth and inflation. But in the longer run, as we saw with the internet, as we've seen with all these major technological advances in the past, they do, eventually flow through to productivity gains, help dampen inflation, help support economic growth. It tends to be a rocky road to get there, and we're negotiating that road at the moment.
Okay. No interview with an economist without mentioning Trump. So what are your thoughts on the impact of President Trump, perhaps for the remainder of this year, certainly around markets?
Yeah, look, I think his bark is. I think the markets are starting to take his pronouncements in their stride. Again, if you look at the Iran situation, he's threatened numerous times to bomb them back into the Stone Age, and markets are sort of now taking that with a grain of salt. I think he is trying to, do a deal and end the war. But Iran seems to be driving a hard bargain at the moment because they think they hold the cards, and they still control the Strait of Hormuz, and all the bombing that the US is doing on Iran doesn't seem to faze them too much. So we'll see how that plays out. But the markets, I think, are still counting on a deal being done, and hopefully Iran, I think, sees sense in wanting to do a deal. On the tariff front, again, he's still playing around with tariffs, but what he's just announced recently is just putting back some of the tariffs that were knocked out by the Supreme Court. The net effect on inflation, I think, will be pretty moderate. But I think, to sum up, he's still a factor in markets. But ultimately, we go back to what has been called the taco trade. We push, as we saw with tariffs, as we've seen with Iran, when push comes to shove, when some of the things he's done threaten markets and threaten the economy, he does pull back. And that is still the guiding light for markets, is that Trump will taco when and if need be, rightly or wrongly, but so far that's been the correct call.
Okay, and then finally, just Australians, as you well aware, have a love affair with property. It obviously has come off. Certainly Sydney, Melbourne. What is your general thoughts on the property market over the next 12 months too?
Yeah, look, I don't have any positive things to
Right.
say there, unfortunately. If you think about historically, we had the two recent house prices corrections in Australia nationally around about 8% in 2022 when the RBA raised rates, and 2019 as well. So the last rate rise cycles caused an 8% correction. This time around, we've had the rates going up, plus the budget changes for investors.
Yes.
So it's a double whammy. At the moment, nationally, house prices are down, as at July, down 2% from their peak. Sydney and Melbourne are down around 5% from their peak. So you've got to think that there's probably more of that to go. I think over the next 3 to 6 months, we'll probably see more gradual declines in the market. I'm not talking a crash, but
No.
you have to anticipate something at least of what we've seen in the past two cycles, maybe a bit more because of the extra investor, in the fact that we've had the tax changes on investors as well. So again, if there's any silver lining out of all of that, is it's doing some of the RBA's work in slowing the economy, reducing the need for the RBA to raise rates further.
Okay. David, thank you very much for
mate.
sharing your
Thank you.
insights with us again. For all our listeners, if you'd like any more information on Betashares, please give us a call, or just to simply give us an update on your own financial circumstances, 9003 4100, and look forward to speaking to you guys again. Thank you.